back in Sydney with Al Clark, Head of Investments at Colonial First State. Thanks, Al, for coming on board again today.
Always a pleasure, Paul.
I think we caught up last quarter, and funnily enough, here we are, 12 to 16 weeks later, and not much has changed. There's a lot going on in the world.
There is.
A lot of things to be worried about, that's for sure. But dare I say it, markets have sort of shrugged their shoulders at it. We saw that decline, that significant decline around the tariffs back in April, May.
Yep.
And then markets shrugged their shoulders. We woke up this morning to another record high. However, there's still things to worry about. Your thoughts?
No, you're right. And it's some people could maybe suggest it's complacency, but I think there's reasons to be positive in the sense in the US we're talking about mainly, right? So the one big beautiful bill that Trump released ended up being a lot more spending, a lot less spending cuts than expected. So that's stimulatory. The Fed looks like they're probably going to ease interest rates, having sort of pushed back against it. They're probably going to ease next month. And you've also started to see earnings from a lot of the big companies continue to be really strong. So we've just finished the Q2, or nearly finished the Q2 or the second quarter earnings season, and Microsoft, Meta, Google all reported really strong earnings. So they're the positives, and I think that's why the market's continuing to find new highs, but the negatives continue to stack up. The first most important is they're already really expensive. They're very expensive in the US equities, we know that. And then the other one is the one you're sort of getting at, which is Trump's approach to everything. It's been haphazard and chaotic, and that's hard to deal with.
Yeah, for sure. In terms of the idaws portfolios, which you've been part of the construction from day one, we had an allocation for our retirees, which had a lot of indexation, up to 45% index, which is a passive approach to investment. In most recent months and live at the moment, we've been switching about 20% of that money, of our client money, into a real return fund, which is a portfolio that's been developed in the last 9 months with Colonial First State, and many of our clients are now in that right now. Now, the objective behind that was to de-risk the portfolio for those retirees. Those are the clients who are drawing down an income. Movements in that space right now and what's happening in that portfolio?
Yeah, so the way you set it up is right, is to de-risk. We've got to remember, it's not to go to no risk.
Correct.
So we still need to get a return. So the return objective for that fund is around that sort of inflation plus 4 to 5, so cash plus sort of 4, that's what you end up with. So we still have to run some risk. It's just, we've been running less risk in that fund than we'd expect to in a normal environment. And as we sort of discussed earlier, it's far from a normal environment. So the fund's been going really well, but we're only running around about sort of 45-50% in equities. We've spent a lot of our exposure in mid-risk assets like infrastructure, high yield debt, some private debt. So those things that we think we're not having to run quite as much risk, but we can still get that return. So overall, it is de-risking from the index, exactly as you said, but we believe in a much more risk-controlled way. And to date, it's only 9 months, but to date, it's been performing really well.
Yeah, and it's like, one for a better term, it's a dynamic allocation where the asset allocation within that portfolio does move. And the reason why we talk with so much confidence behind this is because this is a lead on from the MLC days. Where you're running that portfolio with the team at MLC for well over a decade, and we bring that sort of, I guess, intellect across into the CFS portfolios, and that's why once again the ratings have been so strong as well. The ratings with the rating houses. Yeah,
we were able to lean on our track record from MLC to get a Lonsec rating, recommended rating for that fund, even though we didn't have a track record. So they were just leaning on that sort of confidence of what we've done in the past, which was great. And to date, we've rewarded their confidence because, as I said, it's been going quite well. I can't help but watch how we're going against MLC. We've been outperforming for 9 months, so that's always nice.
Absolutely. But this is also part of the idaws story, is to lean on the likes of Al and the team and to have external research houses like the Lonsecs of the world look at them and say, they get good ratings because of the history and the legacy of the past, and the performance live right now is delivering, which is exciting.
No, it is. And you sort of mentioned it's dynamic, maybe just on that, like right now, given what's going on in the US, there's a lot of haphazard and chaotic Trump decisions being made, the most recent one being that he's going to tax 15% on Nvidia and AMD sales, anything they sell to China. So it's almost like they're just clipping the ticket for anything that gets sold overseas, which is just sort of strange. So there's a lot of strange things. So if you own assets in the States, you just don't know what the next tax is going to be, what
move,
tariff,
yeah.
or so you just don't know. So we're starting to look at putting protection on. So this is part of the dynamic. We're looking right now at protecting. As I said, we've got around 45-50% equity exposure. A lot of that's US just by the nature of global equities. We're looking to actually protect that right now. So we're just doing some work with our derivative team, just because we're not sure where the next policy chaos is going to come from.
Yep, and this is the real return. This is true to label. That's what it's there for. Now, the other component of the portfolio within idaws is the Builder series.
Yep.
We talked a good year ago on this, where there was a pullback on the US at the time. This would have been around about September, October last year when that was happening. And also, even today, we look at the NASDAQ today, still running quite hot. Are we still either pulling back or de-risking in that space like we were a year ago, or where is that at now?
Yeah, so the stuff that we did over that sort of 6 months from sort of September to March was mainly moving away from global, particularly US, into a lot of other stuff. So we moved into emerging markets, we moved into small cap equities, we moved into some private debt, so we're trying to diversify away from global equities. They've kept, to a degree, they've kept up, so it hasn't actually cost us much. Right now in that fund, we're looking to diversify further. So it's not going to happen as quickly as it does with real return, because this is more longer term accumulation and longer term settings for that fund, but we're looking to continue to broaden out because the US equities continue to get expensive. It's hard to know exactly when it'll turn, but I'm pretty confident it will turn.
Yep.
So we don't want to be stuck holding too much US equities. We want to just keep looking for ways to broaden out. The one you'll notice that's going to show up now is some private equity. So we've just started getting calls from JP Morgan, who's going to manage our private equity for us, onto private equity deals. So that's starting to bring our global equities down, so US, into things like private equity. So that's the one that will start showing up in your clients' portfolios.
That's right, and you mentioned a turn will occur at some point in time, but that's why the idaws portfolios are a blend of that active and some passive in there. So you do get the two management styles within the portfolio to help navigate through those times. Another hot topic, Al, that's been coming out of Victoria has been the vacancy rate in commercial property, particularly in Melbourne. Office space, there's a work from home mandate that has been implemented in Victoria. Colonial First State, the exposure to this space, where is it at, and particularly within the portfolios that we hold?
Yeah, so the Builder Fund has exposure to our unlisted property, so we do hold some commercial property. We partner with Mercer in that endeavour. That fund has been underweight office for a long time, so we're talking about 3 years.
Underweight.
So underweight versus there's an industry benchmark, so that's how the asset class is measured against that benchmark. That benchmark holds a lot more office than we do, so we've had a lot more exposure to areas like industrial rather than office exposure. That hasn't changed much recently, mainly for the reasons you're talking about. That reconciliation around how much footprint do different companies need in offices in Melbourne is still settling. It hasn't settled and found its equilibrium, so we're still steering clear of increasing our office exposure. So we've been underweight and we'll stay underweight at the moment.
Okay, I think that's music to the ears of investors to hear that as well. Well, thanks again, Al. Great to catch up here in Sydney, and we'll see you in the next quarter.
Excellent. Cheers, Paul.